financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
Friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride. My name, as you heard, is Jerry Robinson. I'm an economist, author of the book called Bankruptcy of Our Nation. Yes, indeed, the nation is bankrupt. In case you didn't know, in the month of June, the United States government borrowed more money from taxpayers, future taxpayers, more than they spent during the first 2 centuries of the United States of America's history, right? So going all the way through the first two centuries, from 1776 all the way up to about 1979, in the month of June, the United States spent more money than all of that money that was spent during that whole 2 centuries just to prop up this current economy. How about that? How about that? And now we're extending economic benefits for people who are unemployed. I thought we were supposed to have a V-shaped recovery here. What is all of this about extending benefits? Why should we have to do that whenever the economy is obviously, the stock market's already back at new all-time highs? What could possibly be wrong? Well, a little bit of sarcasm for you on this week as we are staring at a very difficult economic situation as we move forward, despite what the P.T. Barnums in Washington tell us, and despite what the Fed has to say, we are facing a gargantuan problem. And today's podcast is entitled How to Profit from the Fed's War on Cash. The Fed has a massive war on cash. This has been going on for some time. The Federal Reserve, the way that it operates, of course, is it creates these boom-bust cycles that we go through. And this is why the Federal Reserve, in many ways, should be ended. It's a private bank that, actually does the role that the Constitution specifically doles out to the Congress. That is Article 1, Section 8, that the Congress has the power to coin money. Of course, through the Federal Reserve Act of 1913, we have since transferred that to private banks, and so now they're the ones who issue our currency. And then, of course, they also control the money supply, the circulation, and they also determine interest rates of what they're going to be. And that's really what today's podcast is all about, is the fact that the Fed has made a pretty big decision, or at least they're getting ready to make a fairly big decision about interest rates. We already know that interest rates right now are at 0. We know that the United States dollar has been falling pretty rapidly over the last several weeks. And we know that as a result, gold and silver and Bitcoin and many other asset classes have been rising due to that falling dollar. And so this trend, which has been in effect for several weeks, looks set to continue based upon the Federal Reserve's latest policy statement. So I want to dive right into that. And I have a headline here from Wall Street Journal dated the 2nd of August. The headline is entitled, Fed Weighs Abandoning Preemptive Rate Moves to Curb Inflation. Central bankers look to change long-running strategy to encourage lower rates, shift unemployment inflation dynamic. So let me read you a little bit of this article because I think this will really lay the groundwork here for what we're talking about and how you can profit from the Fed's ongoing war on cash. Let me read you part of this article here from the Wall Street Journal. The Federal Reserve is preparing to effectively abandon its strategy of preemptively lifting interest rates to head off higher inflation, a practice that it has followed for more than 3 decades. In essence, what that has just basically said is that the Fed is looking at no longer being proactive and preemptive in its rate hikes in order to tame inflation. Let's continue. Instead, Fed officials would take a more relaxed view by allowing for periods in which inflation would run slightly above the central bank's 2% target to make up for past episodes in which inflation ran below the target. So for those who may not pay attention to the Federal Reserve, or for those who are not too familiar, the Fed has a 2% inflation target that it has long stated. It's stated that for quite a long time. So 2% seems to be the amount of inflation that the Fed is willing to put up with. But because there is a thing called a lag effect or a lag factor when it comes to central bank policy, Federal Reserve policy, the Fed has to act preemptively. Otherwise, there's a chance that if it waits until inflation gets all the way to 2%, and then it tries to raise rates to rein in inflation, that it will lose out on its ability to do that, and inflation could run a little higher. And that's what, up until now, the Federal Reserve has not been willing to do. So they have been preemptively raising rates to head off any kind of inflation or inflationary pressures. And they do that early because of this lag factor, right? This lag effect. If you study Economics 101, central banks, when they raise rates, lower rates, print money, whatever it is, there's a lag effect. It takes it takes a bit for it all to kind of work through the system. And so whatever the Fed wants to have happen 6 months from now, it needs to start doing now because it takes a little bit of time. And so this is a really profound shift here that the Fed is talking about, and it's extremely bullish for things that would go up in times of inflation. It's extremely bullish for inflation itself, but it's also very problematic for the U.S. dollar and things like that. Let's continue. The article continues. Fed Reserve Chairman Jerome Powell hinted at the shift at a news conference last week when he said the central bank would soon conclude a comprehensive review of its policymaking strategy that began last year. Mr. Powell initiated the review with an eye towards beefing up the Fed's ability to counteract downturns in a world where interest rates are lower and more likely to remain pinned at zero. Even before the severe shock from the coronavirus pandemic, the Fed had grown concerned about spells of low inflation that have bedeviled authorities in Japan over the past 2 decades and in Europe for the past decade. The change being contemplated now is a way of essentially telling markets that rates will stay low for a very long time. Right? Markets have already likely picked up on this change given the continued declines in long-term interest rates. The changes on their own will do little to provide more support to the economy right now because investors already understand that the Fed isn't likely to raise interest rates for years. So before I continue, in essence, the Federal Reserve is conducting a comprehensive policy review of how it's handling inflation and unemployment and all of this. And for decades, it has had this preemptive strike against inflation. It has had a bias against inflation. In essence, what this article is telling us is that the Fed has not only lowered interest rates to zero and tried to convey to investors that it's going to leave interest rates at zero for a long time. In fact, if you listen to the Federal Reserve Chairman talk about interest rates, in fact, I have a clip. Let's just hear him real briefly talk about the Fed's thoughts upon interest rates. Roll the tape.
We're not even thinking about raising rates. We're totally focused on providing the economy the support that we'll need. We think that the economy will need highly accommodative monetary policy and the use of our tools for an extended period. And we're absolutely committed to staying in this until we're very confident that that is no longer needed. So I wouldn't look for us to be sending signals about cutting back on facilities or anything like that for a very long time. We're in this until we're well through it. And I think this, I think the picture is you have the lockdown, then you have the reopening, but there's probably going to be a long tail where a large number of people are struggling to get back to work because those heavily affected areas of the economy are going to be challenged, really, to employ the millions of people who are now out of work. I think 14 million people are now out of work who were working in February, something like that. So That's going to take a while, I think, in everyone's reckoning. And everyone should know that we're going to be there for all of that.
That's right. So the Federal Reserve, that's Jerome Powell, by the way, at a press conference after the latest meeting in the month of July at the Fed. But as you can tell from his tone and from his language, they're not even talking about raising interest rates. Interest rates now at the zero level, 0% interest rates for the most part. And yields, of course, have been dropping as investors are picking up on the cue that the Fed is dropping, and that is that we are not going to raise interest rates. Now, when you go back and you take a look at the actual historical interest rate here in the United States, you'll find that for the last, past the last several decades, the average interest rate is somewhere between 4 and 6%, right? If you go back and you look, I think 5.7%, I can't remember the exact number, but it's somewhere around there. And that's way, way, way above where we are right now. I mean, we have 0% interest rates. And what happens when you have 0% interest rates? Why does the Fed use them? Well, because whenever you have an economy that is teetering on the brink or is, suffering from, slow growth or, maybe no growth, then 0% interest rates causes more speculation, right? It fuels speculation. It fuels credit. It fuels borrowing. It fuels, buying things on credit. And it also pads corporate earnings, right? Because if you're paying debt and interest rates are low, then you're paying less in interest or whatever. It also certainly helps the United States government's deficits because interest on the national debt, of course, is massive. And so anytime interest rates go lower, that behooves or it helps, the federal government and even state governments. So overall, lower interest rates serve to provide a near-term boost for corporations, individuals, and governments. The problem is that when you leave them at zero, you tend to create a bunch of froth. You tend to create a lot of excess. It really creates a lot of market disarticulation. And so, given the fact that the rates are at zero and they're nowhere near their historical levels, you realize, and the fact that the Fed says we're going to leave them here, and we're not even talking about raising them, and in fact, we're going to leave them here for a long time, that's sending a massive signal to who? It's sending a massive signal to several people. But first, think about the savers. Imagine you are just an average Joe out there who has saved money and you want to put it into the bank because you don't want to take on the risk with these, with the stock market. You don't want to take on, some of the different risk that's out there. You see the writing on the wall and you say, I want to just put some money in the bank and stay safe. Well, that's not an option, is it? You can't put money in the bank. We haven't been able to do that for a long time anyway. I mean, the Federal Reserve has had interest rates at zero pretty much, ever since the 2008 crash, with a brief respite when they raised rates temporarily in just a few years ago, but then they had to bring them right back to zero. So savers are getting hosed here, right? Savers can't get any kind of return by just simply keeping the money in the bank. And that's exactly what the Fed is trying to stoke. It's trying to get savers to take money out of the bank by leaving interest rates at zero and to push it out into risk assets. They want you to buy risk assets, right? They want you to take on risk. They want you to borrow. They want the borrower to borrow. They want the corporation to borrow. They wouldn't have interest rates at zero if they didn't want this to happen, right? And so they don't want money in the bank. They want money out sloshing around. That's what they want to have happen here. They want people who are scared and on the sidelines to get out there because they're saying, we're not going to give you a return if you put it in the bank. There is no safe place for you to put it. You have to go out and you have to take risks, right? It's exactly what the Fed is saying to the average individual. It's immoral, by the way, that they have interest rates at zero. It's completely immoral that they would actually do this because, A, for the saver, right? But B, they know full well they can't leave them at zero. They're doing this to stoke the animal spirits in the economy. They're doing this to create more desire for risk assets. at a time when there is already far too much risk and already far too much over leverage. So what the Fed is doing is highly irresponsible, and it's going to lead to even more carnage ahead. This is not a solution. This is in no way, shape, or form a real solution for the American economy. This is kicking the can down the road. So let's continue on with this Wall Street Journal article. It says, because of the pandemic, Mr. Powell tabled discussions this spring over the framework review. The Fed resumed those discussions at their two-day meeting last week and could seek to conclude them as soon as their September 15th and 16th meeting. That one's coming up here in just about a month. The Fed formally adopted the 2% inflation goal, a level it regards as consistent with healthy economic growth back in 2012. And at that time, short-term rates were also pinned near zero. But central bankers, economists, and investors still expected those rates to return to more normal levels of 4% or so once the economic expansion matured. Even though the pandemic hit, those rates were stuck at much lower levels than 4% for reasons that weren't expected to change soon, such as demographics, globalization, technology, and other forces that have been holding down inflation. The Fed justified preemptive rate increases because monetary policy works with a lag. We just talked about the lag factor. Let me just quote one more thing here from Federal Reserve President from Philadelphia, Patrick Harker. In an interview last month with Mr. Harker, he said he would prefer to hold rates at low levels, quote, until we see a substantial move in inflation to our 2% target, with inflation ideally overshooting it a bit. So, in essence, what this article is saying is the fact that, and what we're getting now from the Federal Reserve and likely to hear at the next meeting, is that they are not going to raise rates in a hurry to overcome any kind of inflation. In fact, they want inflation to go up above 2% before they actually begin to pull the trigger and start to raise rates. Right? So that means one of two things. A, it means that they think they're going to see inflation creeping up, official inflation. By the way, we should admit that real inflation, the Fed doesn't track, right? They don't really track that. I mean, when you go down to the grocery store, you see prices rising, right? I mean, you see prices rising everywhere. So when the Fed says inflation is not going up, first of all, it's just kind of comical. But secondly, their official inflation figure that they monitor, this is telling us that they might expect that number, that official number, to go up quicker than they desire, which means that they really don't want to raise interest rates in other words, they're trying to get themselves out of the pickle they've put themselves in, right? So they had this 2% inflation target that they said, okay, we'll raise rates once it reaches that level. But now the fact that they're changing their minds on that tells us a couple of things. Number one, like I said, maybe inflation is going to hit that target quicker than they expected, which we fully expect. And this is, of course, them preemptively saying, so we're not going to raise rates when that happens so it doesn't freak out market participants. It also suggests to us that it's going to be okay with inflation, which is, again, not good for the saver, not good for the consumer, not good for, pretty much anybody for that matter, but it is good for certain asset classes. So in other words, everything in U.S. dollars is going to be going up. And the Fed says we're not going to step in and try to slow it down too quickly, right? We don't want to jump in there and slow it down too fast. So how do you profit from this? I mean, that's really kind of the point of today's podcast. I mean, you got a falling U.S. dollar because of Fed policy and because of a dastardly response from Washington about how this whole thing has been handled, right? This 2020 crisis is it's one for the books. And if you look at China, for example, China did not have to go into massive, incredible amounts of debt. They didn't spend, the equivalent of 2 centuries worth of money in a period of 30 days like the United States did just to dig itself out of its hole, right? And they haven't even really dug themselves out of the hole yet. But not only that, not only did China not do that, they also have an interest rate sitting near 4%. If the United States had a 4% interest rate, we would probably see our economy buckle. I mean, can you imagine if interest rates just simply went back to their normal level of 4 to 6%? I mean, you imagine how many businesses would be suffering, how many how much pain there would be in the economy, how many job losses, permanent job losses there would be. Everyone is over leveraged to the hilt in the United States. And not only are we over leveraged, we've taken on even more leverage in the wake of this public health crisis in order to stave it off. So if we don't get over the next 6 months, if we don't have this quote unquote V-shaped recovery that the optimists keep telling us is going to come, then you're going to have a whole lot of companies that have taken on a whole lot of debt and they're not going to be able to pay for it. And that's going to be a really, really bad thing. I mean, we have mortuariums on things right now. And in fact, the president has even signed some executive orders trying to do things that only the Congress can actually do because, there's just a lot of problems right now. And sadly, for individuals, if this economy, if we don't see people going back on planes, if we don't see people going back, and staying in hotels and over consuming and, charging up the credit card like crazy and, dipping into their savings and using, if we don't see everybody just overspending by the end of the year, then we're going to be in a bad, bad place, right? So everything right now that we have is dependent upon this idea that everything's going to get back to normal in a hurry. And much of that has to do with some sort of vaccine, right? There's this hope that there's going to be a vaccine for this coronavirus and that everyone is going to take that. When you really think about all of the assumptions that are built in to the future market returns, they're all based upon everything being rosy. It's a best case scenario that's being painted by stock prices, right? They assume that everybody's going to be back flying planes by the end of the year, and maybe they will. It would be nice if we, can get out of this mess. But how realistic is it that we're going to see that by the end of the year? And the reason why that's important is because so many people have leveraged themselves to the hilt. Many people are using credit cards to buy groceries right now because they can't make ends meet because they have, they lost their job and they're not getting their unemployment benefits to the same level that they were. Many businesses have taken on a tremendous amount of leverage here to get through this time because they think that everything's going to be okay 6 months from now, or at least much, much better. You have major corporations out there on Wall Street that have borrowed to the hilt to get them through this difficult patch of economic uncertainty. And if they don't see a rebound, a massive rebound in demand, they're going to have a real big problem on their hands, right? Earnings are going to get hit and all kinds of things. So it's a difficult time. And the Fed has just got this massive war on cash. And if you're holding US dollars in this environment, you're literally just losing money. You talk about risk. Risk is holding the US dollar whenever everybody has already told you that it's going to continue to be going down because they have 0% interest rates and they're leveraged to the hilt. And on top of all that, you've got the Fed saying that as price pressures begin ramping up, the Fed is going to stand on the sidelines and watch and hold interest rates near zero, even as inflation begins to, official inflation rates. We know that real inflation is already up, but official inflation, it's going to begin going up even to that 2% goal. And the Fed's just going to stand there and tap its foot is what it said, because it doesn't want to get in the way of this price recovery, right? And so they're going to leave interest rates near 0% even during that time, whereas before in the past they would have got ahead of it. So how do you profit from this? Number one, obviously not the dollar, right? So if you're holding the US dollar in this environment, what I mean by that, if you have a lot of savings in the bank, or if you're just sitting in a lot of cash because you don't know what to do, that's one of the more dangerous places. That's very ironic. It's very sad, and in many ways, it's quite immoral that the central bank has destroyed our currency in such a way. However, you simply just can't put your money in a jar and go bury it in the backyard, because if you come back 10, 20 years from now, you're going to find out how much your money has lost. I was watching, this is kind of just off the topic, but I was watching an old Andy Griffith the other day with my family. My sons kind of like to watch, some of these old shows, and I do too. So we were watching this old Andy Griffith episode, and Barney Fife, Barney Fife, I love Barney. But Barney is renting a room from Mrs. Mindlebright, and he has one room there, and he pays $6 a week, and he's complaining about the price of paying $6 a week to rent a room, right? And you start to think to yourself, that's $24 a month, right? To pay for rent, right? Who pays $24 a month for rent now? What had happened? Did houses suddenly become better? Did something suddenly, are the sticks and bricks that make together these apartment buildings, are they better now? In reality, what it is called inflation, right? Inflation just constantly robs us. So what cost you 50 cents back in the 50s now costs you $5 today, or what cost you $6 a week, back in the 1950s, now costs you $100 or $100 or $150 today per week. So this is called inflation. So if you put money in the jar and you go bury it in your backyard, just straight up cash, you're going to lose. I mean, you're an instant loser at that point. So you can't leave your money in cash, right? That's actually one of the more dangerous places to be, based upon what we know now, as the Fed floods the economy with money, as we are borrowing to the hilt and they're leaving interest rates at zero. Cash is a very dangerous place, right? So what are you going to do? Where could you possibly put the money? Well, there's a few places. Now, of course, you don't want to put all of your money into any one basket. We teach the importance of diversification, and we don't mean diversification is holding some financial stocks and then some technology stocks. No, we mean asset class diversification. So there's lots of different ways for you to, put your cash to work. Personally, one of my favorite areas in this current environment right now is real estate. Real estate, in my opinion, is a great place to put cash to work. Now, not just any kind of real estate. We talk about real estate quite a bit here at Follow the Money with our members. And our favorite kind of real estate is real estate that is, of course, in a good location and that is not overpriced. We're not talking about flipping McMansions or anything like this, but actually buying good 3-bedroom, 2-bathroom homes in a working man neighborhood, especially in areas that are not seeing massive urban flight right now. We're not saying go and buy, properties in places where people are fleeing. You want to buy properties in desirable areas. But real estate is a place that you can put your money, and then once you put that down payment on the home, and maybe you're going to buy a rental property, then when you get that rental property, you put your down payment down and everything, you got your money down. Then when you start to get rent payments, anything over and above your overall mortgage, that's literally just a dividend for you, right? That's a dividend for you from that asset. And so when I look at real estate right now, I've got a few deals sitting in front of me right now that I could do. And one of them is going to be basically paying an 11%, quote unquote dividend, right? That's what I'm earning per year, an 11% dividend per year. And then plus you get the capital appreciation. So if I'm looking at something like a piece of rental real estate in a nice neighborhood, in a good area where jobs are pretty secure, where I live is not too far from the Walmart headquarters, right? Walmart headquarters is just about 50 miles from me, and maybe even less. And so there's a lot of people around here who are going to be okay. Is Walmart going to go out of business? I don't think so, right? It's probably going to be around for a long time. Are Walmart suppliers going to go out of business? Well, probably not too many, right? So you're going to have a lot of people around here that are going to need a house because they have to live and they got to work. And so if I can get a nice property that pays me a 10 or 11% dividend every single year, and also I get the capital appreciation, well, heck, that's a lot better than putting my money in cash and leaving it in the bank, isn't it? Now, I got a few things I got to deal with there as a landlord. Not everybody wants to be a landlord. So real estate is just one option, but I think it's one good asset class. Another area, of course, that should do well when inflation is raging is an old one that we've talked about for a long time here, and that's precious metals, right? So gold surged to a new all-time high. Just recently, over $2,000. The yellow metal is continuing its ascent. All kinds of bullish fundamentals here for gold. You got central bank gold demand. Central banks are buying gold and telling you to not do that, of course. You got geopolitical tensions, U.S. and China at each other's throats. You got low interest rates, which bodes well for gold. You have a weakening U.S. dollar, which only is good for gold. You've got political uncertainty here domestically. That's good for gold. You've got economic catastrophe, right? Undoubtedly here in the United States. That's positive for gold. We could just keep going on and on and on and on. Now, again, you don't put all your money in gold. But gold is an example of something that's better than putting your money into a jar and burying it in the backyard. The Fed has a war on cash. And so if you are not somehow protected from their war on the cash in your pocket, then you're not going to be able to keep up with the inflation that is certainly going to be coming, right? And we know that inflation just continues and continues. It's like a guaranteed deal, right? You're going to keep seeing prices go up. It's devastating. What else can you do? Well, there's clearly Bitcoin, right? Bitcoin and cryptocurrencies. Now, we only put 5% of our total investable assets in cryptocurrency. It's been that way for a long time, since 2012, and we haven't changed. We keep it, about that level, and that's worked out to be great. But why Bitcoin, and why even the cryptocurrency area? Well, cryptocurrency is decentralized finance, right? That's kind of what it is. Bitcoin is kind of an opt-out of the financial system. And Bitcoin is going up in this environment along with gold as the dollar is falling. So because we have so much money in the system, and because there is so much money on the sidelines right now with the stock market, you can build the case that people are going to be looking for different places to stuff their money. And so therefore, we would expect to see more price surges ahead for cryptocurrencies, but specifically the big ones. Bitcoin is where we have the large portion of our cryptocurrency holdings. We're long-term on Bitcoin, buy and hold, if you will, right? So Bitcoin makes a lot of sense here. And I think you can also build the case for stocks. Let me tell you the bull case and the bear case real quickly for U.S. stocks. You look at U.S. stocks, you say, gosh, they're at all-time highs. Many of them are at all-time highs. Some of them not. Airline stocks aren't, right? Travel stocks are. I was looking at Trivago. You ever seen the commercials for Trivago? It's down like at $2. And, I'm looking at like Expedia and many of these other travel companies. They've been demolished. Many of them have been hurt pretty bad. But travel will return, right? We're going to see travel at some point return. And so many of these travel stocks will recover. But let's build the real quickly the bull and bear case for stocks as a way to protect yourself from the U.S. dollar. So on one hand, you look at a $27 trillion national debt. You look at the deficit that we have. You look at the fact that we have all these people unemployed, and you see that we have these mortuariums that are expiring, and you think to yourself, okay, the stock market now is at all-time highs. The Fed has pumped in all this money, and now, is the stock market even a value at this point? How in the world, why would we want to put our cash, why would we want to take it out of the glass jar in the backyard and put it into stocks at this point because they're so high, right? Well, you could certainly build the bear case, right? And I think I've done that quite a bit. But the bull case is this. The bull case is that we have never had so much money in the system, A. B, we've never had so much money on the sidelines. That's B. C, interest rates are going to be at zero for a very long time, according to the Fed. That's pretty bullish, right, for stocks. Remember what happened back in 2009 all the way out to, 2018 or whatever, 2019. You had this massive rally, as interest rates have been suppressed artificially low for so long, and it drove up asset prices like stocks. So you have, what did I say? You have the a massive amount of money, you got a massive amount of credit, right? Incredible amounts of credit. Unbelievable amounts of credit. You have a ton of money on the sidelines. And what else? You have interest rates at zero and the Fed committed to leaving them there. And then on top of that, for the very first time, I think in world history, you have every single major economic region around the world entering into recovery, right? So we've seen this big collapse in GDP and then kind of, hopefully a bottom here and then kind of a curling up. I mean, it's not that things are going to get that much better that quick, but they're all going to be going from bad, perhaps to less bad. Perhaps that's what's going to happen. That's a little more difficult to discern, but it seems like we're going to be moving from bad to less bad, but all at the same time. So all these global, markets that have been beat down now starting to all curl up, not at exactly the same time, but around approximately at the same time. And you have all this money on the sidelines. You have all this money that doesn't know where to go. And then you have 0% interest rates pretty much guaranteed. So even though stock prices and stock valuations are at ridiculous levels, you realize that what are these people going to do? Are they going to go put their money in a glass jar and bury it? Or are they going to put it in something that's going up, right? And so I think with stocks, it's a little more difficult to be able to know. Just because it's overvalued doesn't mean there's a better option for some of these investors, considering what kind of situation that we're in, right? So it's, how to profit in this environment is basically to try to diversify your way away from the U.S. dollar, right? You can do that through precious metals. You can do that through real estate, where you take your U.S. dollars and you move it into something that's hard, like a piece of real estate. You can do it with Bitcoin, where you get out of the U.S. financial system and you have some of those dollars now outside of the system that they can go up. You can also do it with stocks. But again, you have to be very careful with the stock market here, I think, right? Because for a couple of reasons. Number one, we have that seasonality factor. We're moving into, of course, now August, but also September, which are the two roughest months for the most part in the stock market historically. So if we're going to have a big old crash, you tend to have it in when? You tend to have it in September. Doesn't mean it has to happen then, but that's when it tends to happen. And we're kind of sailing into that time right now, with all of this bad economic news, and they're trying to paint, lipstick on the pig here. We'll see if that happens. But let me leave you with this. We know that the Fed is going to leave interest rates low. We know that, a sell-off in the market is certainly going to have to come at some point. But here's the big takeaway, is that if economic activity doesn't return over the next 6 months, if we don't see a strong surge and resurgence in economic activity compared to what we have now over the next 6 months, then we're going to see everything could change. Extreme leverage has been deployed so that any threat to growth in the next 6 months could really be negative. So if anything changes, if any of the hopes and dreams of these Wall Street analysts fail to materialize, then all these corporate balance sheets that are over leveraged with lots of debt, if we don't see this recovery quick, it's really going to be a problem. So keep that in mind, and think about what the Fed is saying here. It's saying that it's not going to raise interest rates even when inflation is at 2%, right? They're not going to worry so much about the inflation factor. Wow. These are very, very challenging times for not just investors, but for the average individual who is just trying to make sense of the economy here. So leave you with that. Interesting stuff. We'll put a link to this Wall Street Journal article in the show notes today. And if you want more ongoing commentary on the markets and you want to get access to all of our different services that we have here at Follow the Money, just go to followthemoney.com and click on the plans and pricing area. We have lots of great resources for investors, whether you're looking at real estate, whether you're looking at Bitcoin, whether you're looking at precious metals, whether you're looking at stocks, ETFs. We have lots of great information for you, and we'll keep you updated, at least how we are proceeding in the very uncertain days ahead. Hey, Hey friends, this is Jerry Robinson here from Follow the Money Radio, and recently we have been receiving a lot of great feedback about our weekend ETF trend alert service. Perfect service if you are a swing trader or a position trader who likes to know when new uptrends are starting. We send out every weekend the latest ETF uptrend alerts by email for all of our members. Let me just give you some of the latest ones we have sent out that you, if not a member, you have missed. So back on May 8th of 2020, our members received an uptrend alert on solar energy, ticker symbol TAN. Since that alert was sent, TAN has risen by nearly 40%. We also called a new uptrend alert in silver. Many people know silver's on the run. We called that uptrend back on May 15th of 2020. We detected a new uptrend was forming, and since that time, silver has risen 45%. We called a new uptrend on silver miners, the ticker symbol SIL. For our members, we said the silver mining stocks look like they're forming a new uptrend. This was back on April 24th of 2020. Since that time, the silver miner ETF has risen 55%. We did the same thing with gold miners. GDX is the ticker symbol. We called that on April the 10th, a new uptrend alert. And since that time, gold miners have risen 47%. Every single weekend, our members are receiving these alerts. Now, of course, there has to be an uptrend for there to be an alert, but not every weekend we're going to have brand new alerts. But when we do, our members receive them. Wouldn't you like to receive those if you're not a member? Wouldn't that be something that would be beneficial to you if you're a swing trader or a position trader? I would say it definitely is. And if you want to receive access to these uptrend alerts from us, all you have to do is go to followthemoney.com/join, choose your plan, and then begin receiving our weekend ETF trend alert service right there in your inbox each and every Sunday evening. If this sounds like something that would benefit you, just go to followthemoney.com/join, learn all about our services, and choose a plan, and begin receiving your ETF uptrend alerts each and every weekend from Follow the Money. Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812. Well, all right, friends, welcome back to the final moments here of our broadcast. We are now out of time, and it's been such a wonderful opportunity to be here with you. And as always, I like to leave you with a final word, this time taken from the book of Proverbs, chapter 22, verse 1, where it says, "A good name is to be chosen rather than great riches, and favor is better than silver or gold." The Jerusalem Bible puts it this way: a good name is more desirable than great wealth, and the respect of others is better than silver or gold. When forced to choose between a good reputation and wealth, the wise King Solomon, who had both, instructs us to prefer the former. A good name, a solid reputation, is worth its own weight in gold. Sadly, the fool cannot see the wisdom in this proverb and will sacrifice his or her own reputation with others just to make a quick buck. But the wise King Solomon reminds us that these short-term ill-gotten gains are far inferior to the long-term benefits of keeping a good reputation with both God and man. So, if you ever find yourself forced to sacrifice your long-term credibility or even a relationship for a short-term monetary gain, remember Proverbs 22, verse 1, and choose to protect your name and favor before God and men over monetary gain. Don't let greed destroy your good name. And that is just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
All of the information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of ftmdaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.